So, risk and return. This is the topic for week 7 here in FINC 2011. The calculations are less intense. Being here, I assume you guys have both all pass Buzz 1020. So, Buzz 1020 is a very important prerequisite for FINC, especially for today's reading lecture here. So, that is something that's very important. So, first of all, let us go through two potential scenarios for investments. Scenario one, you start with 100 and you are guaranteed to end up with 110. This could be a government bond, a risk-free asset, undefaultable asset, for example. On the other hand, we have another scenario where you have a 50-50% chance. You have a 50% probability of getting 130 and a 50% probability of getting 90, so losing money. Now, what is the expected outcome of this investment here? The expected outcome is also 110. So if we simply do a 50% allocation to 130 plus a 50% allocation to 90, we also get expected outcome of 110. So these two investment potential portfolios both have an outcome of 110. However, obviously, one contains risk and one does not contain risk. And so, if you're an objective investor, you should choose the safer investment, even though it has the same expected outcome. So, hence, risky assets require a greater amount of return in order to compensate you for the additional risk taken. So note that so this is a required rate of return for a risky asset is higher than a risk-free asset because it has a risk premium component to it. So that risk premium also includes the risk-free rate. So you have to subtract that out in order to get the risk-free rate. So this topic develops on the building ideas that I have just went over. So here's the learning objectives. Pretty straightforward. You need to have a lot of solid understanding of previous tasks, and then you'll be fine. So calculating a realized rate of return. So what is the return on an investment? So a return on an investment, when we look at this formula right here, has two components. Okay, it has the capital gains component and it has the dividend component. So you take the total gain, so this is the total gain on the returns, these are the cash flows on the return, divided by the original starting price. So if you remember the formula to calculate a percentage gain, so percentage gain will be new minus old divided by old. So this is new price minus old price divided by old price. However, there's an additional dividend component that must be taken into effect, that when we want to calculate the rate of return. So here's an example of calculating the rate of return. For example, you buy a Commonwealth Bank stock for this price and you sell it for this price. And then you also receive a dividend. What is your total rate of return? So you take the new price minus the old price plus the dividend divided by the old price. Okay, and you get a total gain. So you actually have a capital loss component here, but you have a dividend component which offsets that, giving you a 2.4% rate of return. For a very short period, that's a very good return, but it's mostly coming from the dividend. Calculate the expected return on an investment. So the expected return is what investors expect to earn from an investment in the future. There are two ways that this could be determined. So the first way is using historical results. So this is the example. So from year 2005 to year 2009, these are the returns for each of the years. And then we calculate a average. So this is a arithmetic average of the returns. So we add all of these up and we divide it by the number of periods, n. So we add 21.1 plus 25 plus 18 minus 40.4 plus 39.6 divided by 5. This figure of 12.7, as you can see, is the average of historical returns. However, it doesn't very tell us a lot. It tells us the expected return per year. However, it is a very skewed number since we have major swings and major fluctuations that is smoothed out by the average. Another thing we could do is what we call a subjected probability weighted distribution. So here we have a return figure. So 0 to 25%, we give it a 1 out of 5, so a 20% probability. 25% to 0%. 0% or negative 25% has a 25% probability. So has a 25 to 35% return. We have a 20% probability. And for a 60% probability, we have anything between 0 and 25%. So here we could take the midpoint and give our subjective, an attribute, describe our subjective probability to it, and then there we get a expected return of 11%. So this is not very precise. For example, you want to have more tailored, so 0 to 25, 0 to negative 25% is a massive range. 25 to percent, positive 25 to 0% is also a massive range. So you may want to have a more tailored and more specific, but you sort of get the idea of what it is like to use a subjective probability distribution. Geometric versus arithmetic average rates of return. So geometric average rate of return, what this shows, is the compounding effect of an investment over time. So what we have here, so this is a geometric average return. Before we go into that, let me just show you why it would be important for us to have that. So if you have a $100 investment starting off at year 0, you have a 50% increase in your investment portfolio, and then you have a 50% decrease in your investment portfolio. What you would get is a 0% arithmetic return. However, what in reality happened to your investment portfolio is that you lost 25% of your return. So even though you lost 25% of your return, the arithmetic mean would actually show a 0% effect, which is not really reflective of reality. So therefore, a geometric return takes into account the effect of compounding and the returns over the entire period. So you take 1 plus the rate of return for year 1, plus 1 plus the rate of return for year 2, plus 1 plus year 3, 4, 5, to 1 plus the rate of return of year n, so that's the final year. You take all this, you multiply them together, and then you take the 1 over the nth power. So the root power, not the root power, not the square root power, but 1 over the nth power minus 1. That's a geometric return. So look at this. If we have a 50% gain and a 50% loss, that actually gives us a 13.4% loss. So geometric returns are more are a better representation of what you would actually expect over the entire period. So historical rate of returns here, we are talking about what we expect, okay? What we expect over the historical performance. So here we have the historical performance of bank bills, so government bonds, and then the all ordinaries accumulated index. So all ordinaries is like the ASX. It is an index of all equities listed on the ASX. So the assumption here is that within the rate of return, there is not only a risk-free rate, but also a risk premium component. Okay. So for the rate of return on equities, we have to have the rate of return of a risk-free asset because it is riskier than a risk-free asset. All equities are riskier than a risk-free asset because of this, because there is a risk premium in addition to the risk-free rate. So by definition, equities have to be more risky than fixed income, than risk-free rate because of this formula right here. So what we can see here is that the risk premium is different for different countries. Now, obviously, the risk-free rate is also different for each different central banks because they have the ability to set the risk-free rate, which is the government, usually a long-term government bond rate. For example, the 10-year U.S. government treasuries or the 10-year Federal Bank of Australia's bond yield, bond rate. So that would be considered a risk-free rate. So here we can see the risk premium in excess of the risk-free rate that is attributed to each of these countries here. And here we can see the expected market risk premium. Okay. So this is the additional component in addition to the risk-free rate to compensate investors for the additional risk components taken when investing in equities. So total risk encompasses the riskiness. So total risk encompasses the volatility and unexpectedness of investments. So it is the extent to which future cash flows on a securities are expected to vary. So even though it is the expected future cash flows or future volatility, it is actually a long-term measure. So year on year, it would fluctuate by quite a bit. As you can see here on the all ordinaries accumulation, year to year, it fluctuates by actually quite a lot. However, on the long-term average, the mean of 15.4% could be expected to hold true. So measures of risk, we have variance and standard deviation. Think back to your Buzz 1020 or your HSC or high school IB days, what you would see here is that variance is the average of squared differences between the individual realized returns and the expected return. So once again, what does risk measure? Risk measures the volatility, okay, the variance, and how far your expected, how far the actual outcomes stray from your expected outcomes. Now, what does variance show? It shows the square difference between the actual outcomes with the expected outcomes. So variance is literally risk by definition, and standard deviation once again is just the square root of variance. So calculating historical return is very easy. It is simply the r squared, r bar, which is the mean return expected for the security, and here we have the formula for standard deviation for investment. So you take the square root of the summed differences of your observations to your mean over n minus 1. Now think back to your Buzz 1020 days. We are taking n minus 1 because this is a sample. You can never get a whole population, so this is a sample, therefore it is n minus 1. So here we have an example of calculating the historical risk of a single asset. So first thing we want to calculate is the mean return. So once again, this is the R bar component of the variance formula. So we take the return of the previous years, we add them all up together. If it's a negative figure, then we subtract them, and we divide it by the period n. So here we get a mean return of 12.7%. Now, we'll plug the 12.7% figures here. You can see 12.7, 12.7, 12.7, 12.7 into the standard deviation formula. So we take the square root of each observation's distance to the mean. So here's observation of 2005 to the distance to the mean, observation 2006, 25 to the distance to mean, observation 18 to the distance to mean. And then we take all of these and we square it. We square it and then we add it all together. And after we add it all together, we divide by n minus 1. So we have 1, 2, 3, 4, 5. We have 5 observations. 5 minus 1 is 4. So we divide by 4 observations here, giving us the standard deviation for the market return being 30.8%. Now, what does this tell us? So we have the mean return of 12.7%, and we have the standard deviation of 30.8%. So that tells us that 68% of possible outcomes, we can even project this into the future, 68% of possible outcomes lies within 30.8% of 12.7%. Okay, so either 30.8% above 12.7 or 30.8% below 12.7. So the example suggests that over the sample period, an expected return for all ordinaries, which is the index that we are using, is 12.7%, and the standard deviation is 30.8%. So hence, there is a 68% chance. This is the normal distribution here. 68% chance the future returns on the market will be between 18.1 and 43.5%. So this is a distribution here. Now, calculations of risks using a historical time series of return. So here we could just continue seeing the distribution here. Now, an additional method will be using subjective probability distributions. You simply come up with a subjective probability and you multiply them up, and that will be another method of coming up with risk. So here, if we have a probability of 20%, 60%, and 20% of these outcomes occurring, we simply multiply them together. We get an expected return of 11%. And then, once again, using the 11% as the mean, we subtract each observation with the mean, multiply by its weight. So multiply by its subjective probability weight, plus the weight, and we take the square root, and there we go, we get 13.6%. So this is a subjective probability distribution for coming up with the standard deviation of return, which is a proxy for risk. So the risk of a portfolio is a group of single assets. So by definition, portfolios have to encompass more than one, so 2 or more individual underlying assets held by an investor. Holding a portfolio of stocks reduces investment risk because you can diversify away the volatility. So within a portfolio, individual stocks are more volatile than the overall portfolio. Poor returns on some stocks are offset by stronger returns on others. So therefore, the investment portfolio returns is smoothed out. Let's look at an example here. These are 2 stocks that are not highly correlated, NCP and PDP. So as you can see in this period right here, when NCP decreases, PDP increases. So the combination portfolio of NCP and PDP actually is rather smoothed out. Okay, and here when PDP decreases and NCP actually increases, so therefore the return is actually smoothed out. So this is the idea of how adding additional stocks within a portfolio reduces risk through diversification. However, not all additional stocks would reduce risk and diversification. This is what we call systematic risk that you can diversify away. Here we have two rather highly correlated securities, BHP and Rio Tinto. Both are mining companies with a huge chunk of their revenue coming from iron ore. So if their revenue is primarily derived from iron ore, that means their earnings will be primarily derived from the price of iron ore. And as the price of iron ore fluctuates, revenue will fluctuate, which means earnings will fluctuate. And if earnings fluctuates, the stock price would fluctuate. So therefore, these two companies, because their business practices and business is really correlated, the benefits of diversifications are less likely to be seen. Okay. So risk over portfolio. Once again, we can see that the standard deviation of monthly returns on a portfolio was considerably lower when these two stocks are not so correlated. And then the benefits diversifications are less so when they are closely correlated. So how do we measure the correlation? First, again, we have to go look at the covariance. So the covariance is a raw measure of the degree of association between two variables in covariance. If covariance is positive, which means these two variables move together, when variable A increases, variable B also generally increases. When A decreases, B also decreases. So what covariance only tells you is the direction these two variables move together. So here's how you calculate that. You take the return on security I during interval T minus the mean return for I multiplied by the differences. So between the return on I versus the mean return of J. Okay, and you do n minus 1 because these are samples. So covariance is negative. That means when one increases, the other decreases. And when covariance is negative, benefits of diversification could take place. Covariance continued. So here's a calculation of covariance right here. Covariance continued. Now, once again, covariance does not really tell you anything because the number is very arbitrary. All it tells you is the direction of the movement between these two securities. So if A increases, B also increases, then the covariance would be positive. If A increases but B decreases, then the covariance would be negative. It doesn't tell you the degree, so this doesn't tell you anything. Okay, the figure does not tell you anything. Now, the correlation coefficient, on the other hand, is closely related, measures the degree of association between two securities in a correlation of coefficient. So here you take the covariance. Okay, you take the correlation coefficient between I and J, and you divide it by the standard deviation of I, multiplied by the standard deviation of J. So, now it is standardized. Now the effect of standardization comes into play, and the coefficient will always lie between positive 1 and negative 1. Positive 1 means they're perfectly positively correlated. When A increases by 1, B also increases by 1. When A decreases by 100, B also decreases by 100. Negative 1, which means they're perfectly uncorrelated, also provides a more interpretive measure of the strength of association between securities. So here's the calculation of the correlation coefficient. So 0 is the more uncorrelated they are, the greater the effect of diversification on risk. The more correlated they are, the less effect they have on risk. So if two assets, two securities move together in perfect harmony, in perfect synchronization, what will be an example? Theoretically, for example, Alphabet Class A stock and Alphabet Class C stock should move together. They should have a correlation of 1 because they have the exact same underlying economics. Okay, so you can see moving up like this, you can see this is almost the exact same chart. If I move between these two, this is almost the exact same chart. This shows that the correlation between Alphabet Class A stock and Alphabet Class C stock is basically the same. Okay, there is basically no diversification benefit if you add more a Class A versus Class C stock. However, if two stocks are greatly negatively correlated, you get a greater risk reduction in diversification benefit. And the relevant literature basically shows around 30%, around 30 securities is where the additional additions of stocks to yield less diversification benefit, since it is expected to have basically half the market portfolio at that point. So calculating the risk of a portfolio, here we have the mean return of a portfolio, which is rather easy to calculate. Now we also want the variance of returns. Okay, in order to calculate, once again, we want the Bell distribution to be able to project future expected returns and future volatility. So this is the variance of a portfolio of two assets. If the more assets you add, the more complicated. However, for the sake of calculation, two would suffice. So we take the weight of asset A multiplied by the standard deviation of asset A squared. So weight of asset A squared multiplied by standard deviation of asset A squared, plus the weight of asset B, so x2 squared to the standard deviation of asset 2 squared, plus 2 multiplied by the weight of asset A multiplied by the weight of asset B, and the covariance between asset 1 and 2. So what this gives is the variance return of the expected portfolio as shown. So here we can see the calculation for that. Now, the components of risk includes systematic and unsystematic risk. Previously, when we talked about systematic risk and how correlation affects systematic risk, the more uncorrelated securities are within a portfolio, that are added into the portfolio, the more we could decrease unsystematic risk. So the more securities we have that are uncorrelated, the lower unsystematic risk would be. However, if systematic risk is non-diversifiable, this is, for example, oil prices, or for example, risk-free rates, for example. Unsystematic risk relates to price movements that are caused by events that are influenced by a single company alone. So company management, company cost structure, company supply chains, for example. This could be reduced through diversification. On the other hand, systematic risks relates to macroeconomic events, such as oil prices, such as COVID, such as risk-free rates, such as wars. Okay, these relates to macroeconomic events that affect the prices of all securities and are reflected in the broader market movements. So overall, we can see the total components of risk. We have alpha, which is the intercept coefficient, and we have the slope of the coefficient. All right, so that brings us to the end of week 7, talking about risks and return. A lot of math, a lot of Buzz 1020 knowledge, but here in FINC2011 is just a lot of math. So yeah, that's it for week 7. Take care and goodbye.